What do you see in the lending future? Like, where do you have any idea? Like, where do you think rates will be in the next 2 years?
If you're not focused on global events, then you're not doing yourself a favor. I think more importantly, you have to realize how interconnected the world is. It's vitally important for you, especially if you're an LP investor, it is vitally important for you to bet on the person leading the deal. Lifestyle creep gets really heavy. You start to see the private plane. If you're risking your friends and family's capital and you really haven't done it before, man, I can't imagine going back to Thanksgiving to somebody that's a close friend and saying, hey, I'm sorry I lost all your money, but just join me on the next one, And
there's a lot of people that have lost their shirts in the last year or two in the multifamily space where I am and, other sectors of commercial real estate. What are maybe one or two lessons you learned during that 2008 timeframe that you think would still be applicable to today?
What a wild time. It was.
Hello, everyone, and welcome back to another episode of the Apogee Wealth Podcast. Today's guest happens to be a very good friend of mine. Additionally, he has numerous different hats within the commercial real estate space, and I'll let him speak a little bit on that, but super pumped for our conversation today, and I know you're going to get a lot of value from our guest, Carl Pankratz. Carl, welcome to the show.
Excited to be here. Good to see you, Jonathan.
Awesome. Good to have you. It's hard to give you an intro because, like I said, I feel like you wear a lot of hats in the commercial real estate space. We've worked together in a lending capacity and finding some pretty great deals here in the last year. But I know you do a lot more than that. And so do you want to give the listeners just a brief intro of who is Carl? How did you get into real estate? And kind of what are the things that you do within the space today?
Yeah. First of all, Jonathan, I want to commend you for hitting that intro on one take. Just nailed it. That's very impressive. So I just want to commend you on a phenomenal opening to this podcast. Carl Pankratz, managing director of Blackacre Commercial. So we're a boutique commercial mortgage brokerage based in Texas, but we do business all over. I also I'm a fee attorney for a title company. So we do title insurance throughout just Texas. I'm also an attorney. So we have a small law firm as well, and soon to be in commercial insurance. So seeing real estate from a lot of different ways. Went to SMU where I played football. Back then, it was post death penalty. So my freshman year, we were in the Cotton Bowl. And we probably had a proud fan base of about 1,000 people back then, which was exciting. Go Mustangs. And from then I went to SMU Law School. And after SMU Law School, I got out into Dallas at the right time in 2008, which was prime time to be out in the market, which was also exciting. So at that point, people weren't hiring for real estate attorneys. All the firms were pushing everybody to bankruptcy. So I chose a different path. I went into title insurance right out. I was thrown into the mix of the greatest job of dealing with hair. And so you got to think of 2008, how much hair every title company had. And Carl Pankratz was thrown in a dungeon and thrown a bunch of files that were impossible to close and said, you need to figure this out. And truth be told, it was something I heavily disliked doing. I thought when I graduated from SMU Law School, they were going to say, here's your Rolex, here's your corner office, and here's your $500,000 salary. It was, here's your cubicle, here's your Timex, and then here's your $100,000 or maybe less salary. So that was exciting. But, it was like, what a blessing, because I hear so many people say, in our business, we're good at dealing with problems, right? Well, man, I don't know what that means sometimes, because the hair that I had to deal with allowed me experience to see things so quickly. So, when I'm dealing with loans now, I mean, you think about, that wasn't very fun, but, you think about 20 years later and it's like, something pops up, I can draft an easement to get through it, or I'm dealing with a $94 million project in Texas. And we came to a standstill on, how do we create a condo regime? And I was able to kind of piece all that together and keep the transaction going and everything else. So it definitely shaped me. But from there, In 2013 transitioned to real estate finance, where was the direct lender for Fannie, Freddie, HUD. Also did underwriting. At that point it was you were your own underwriter, so you had to go get the business, and you had to underwrite the business, and and that was a blessing because I got very acquainted with the rules and credit structures, and from then on, I did more, moved to a national brokerage. I did more universal. Then I transitioned to the buy side, where I worked with the amazing Kim Radiker, and we were, I was head of acquisitions on an apartment portfolio that we built to about 7,200 units, and then I went on my own, and that's where Blackacre Commercial was founded, and again the title insurance and other aspects of our companies.
Yeah, that's definitely a lot and way more than, I could remember for an intro, but, appreciate that. And, one question, this is a bit of a tangent, but I think it's what's going to make the conversation fun for the listener. You mentioned getting out of school in 2008. And obviously the market is different now than it was then, right? Like single family today is, I would argue, more or less fine, at least here in Dallas. But commercial's not. There's a lot of people that have lost their shirts in the last year or two in the multifamily space where I am, and other sectors of commercial real estate. Do you think there's any parallels there, and like what are maybe one or two lessons you learned during that 2008 timeframe that you think would still be applicable to today?
What a wild time. It was, looking back at that period, it was, you saw some of the most tragic stories, locally. We were acquainted with people that basically did all they could to join Dallas Country Club, and levered up to the hilt for initiation fees. And, when they lost all of their income, they, in some cases, took their own life because of they thought there was no way out of how bad it was. I think I almost wish I wasn't a working professional in 2008, because everything that I saw made it almost impossible for me to take advantage of the incredible multifamily world that began really in 2011, and then just created, that just compelled itself for 10 years. But when you saw how deep, people, lost, and I think more importantly, it was my first inkling of one day it's business as usual. We're trading transactions, everything's smoothie. And then the next day, credit stops to a halt. I mean, there is no lending. I think that's what was crazy about that time period is, you're going 70 miles an hour, and then there's an abrupt stop where there is no loan available. So kind of thinking about, exits and thinking about, your typical, we saw a little bit of, this in some ways in 2020, although it didn't last as long or didn't go as deep. But, I remember, I'm in the middle of at that point working in the title industry and seeing, layman, and then you see CMBS ground to a halt, and then you see just the depth of the housing crisis. And, it really, it's hard not to let something like that affect you from a risk standpoint. It's just, and then, as a lawyer, you're already overly cautious. And then when you see people lose everything so quickly, and you see the fact that loans can just immediately stop, there's like no lending available. I mean, all that shapes you as you're moving forward, but I will say that back then, as there is now, it's vitally important for you, especially if you're an LP investor, it is vitally important for you to bet on the person leading the deal. And by that, I mean, you need to there's things to watch out for. In our business, for instance, lifestyle creep gets really heavy, and it's that point sometimes where you start to see the private plane, and then you start to see a lot of big things in somebody's lifestyle that is a whoa, 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 whoa. Are you really focused on the lifestyle creep? Or are you focused on having enough liquidity for when things go bad, you're willing to pump some of your own money in? Like, are you still dedicated to every deal? And I think what we saw is, and you're seeing, this right now in our lending environment where liquidity is so important, and more lenders are saying, hey, I want to make sure that your post liquidity after you close this thing is high enough for you to weather problems. And I think that's kind of the parallel you saw of how important cash is when things go wrong, and how quickly, the world of lending as you know it can ground to a halt. So in today's environment, that's not there. There's still plenty. There's debt funds are coming online every day. Fannie and Freddie are still lending, although we can kind of talk about where that is. CMBS has got a lot more aggressive, especially on kind of your 65 to 70% LTVs doing all IO. So the world today is vastly different because, lending is available. So it's a better environment. This is definitely not anywhere close to what we saw in 2008. And by the grace of God, I hope we never see that again.
Yeah, absolutely. And you brought up lending, and you're definitely a very qualified person to speak to this, both as an attorney and a mortgage broker, and general person that just knows a lot about the economics of the U.S. What do you see in the lending future? Like, where do you have any idea? Like, where do you think rates will be in the next few years? A lot of investors, I think, were thinking, oh, we're going to continue to get rate cuts, and they're going to come down at some point. For a while, the saying was survive until 25, and that was a year and a half ago, and that was not the case. That was not a substantive amount of rate relief to get a lot of people out of bad deals. And today we're kind of in this just middle part where, half of the Fed is talking about a rate hike. Half of them are not sure, talking about dropping a rate, 25 basis points. What are your thoughts on all that?
If you're not focused on global events, then you're not doing yourself a favor. I think more importantly, you have to realize how interconnected the world is. You have to, you see that the UK is on its second prime minister in what, year and a half or so. France has had an incredible difficulty in trying to put together a governing coalition in their parliament. Germany, you're seeing so much manufacturing moving out of Germany. So you have that, but then the 100-pound gorilla in the room is the war in Iran. I think that, what was found is, today, as we record this on June 25th, you're starting to see a lot of, oil is now, West Texas Intermediate crude is around $70. Not too long ago, it was at 100. So what a sharp decrease we've seen with the prospect of a deal in place. Well, there's a lot of dynamics to that, and right now it's going. I don't want to get too far into this. We can talk about this at a later time, but what we're seeing right now is that oil has had oil impacts every consumer good. It's just there's not a product or a service that the price of oil doesn't matter, because obviously you need oil to get the supply chain running in any direction. So it's a hyper focus on what's going on with the Strait of Hormuz. And then, the counterbalance to that is, we have an MOU that's signed. It's somewhat of a working agreement, but a big part of that hinges on Israel stopping its combat in Lebanon. And, Israel's not a signer to the MOU. So they haven't assented to this, and in some publications have shown extreme dissatisfaction with this agreement. And so the question is there going to be is there something that's going to break out in Lebanon that pulls this deal away, or it goes right back up? So there's that. So that's a big piece of this. And the second big piece that you got to think about is just we're still we're 6 years removed from one of the biggest global catastrophes that we've ever seen as far as the COVID. But more importantly, every government's response around the world was to pump more money in just to try to survive at that point, because it was such an unknown. So we have so much money floating around, so the question really becomes, is the Fed going to get comfortable with the fact that we're not going to see 2% inflation maybe for a significant amount of time because of all these factors? Is 3 the new normal? Everybody's signaling there's going to be, a potential rate hike by the Fed, but I would push back on that consensus and say, well, look how fast oil has dropped. So everybody that's saying that it's a given there's going to be rate hikes has to kind of see, well, look how quickly, if oil's come down, then inflation's going to kind of tick down. And, just some financial data that came out today that I thought was pretty probative is, you saw that, inflation obviously is a little higher, but personal consumption spending, so personal consumer spending was up 0.7%. And that surprised. And then you saw personal income rose 0.7 versus the 0.4 forecast. So the economy is still kind of moving forward. People are still spending. Now, obviously, there's affordability crisis that obviously everybody discusses. But the question is I don't know if it's going to be as certain as a deal that we're going to see a rate hike. But again, Fed really focuses on short term. The bond markets control long term, and you saw that we're closer to 4.3 today on the 10-year Treasury. So the bond markets have priced in a decrease there, and we're seeing the rates come down there. So the question is there a likelihood that we're going to be somewhere between this kind of 4.2 to 4.5 for the rest of the year? I think that's probably something you'd say that this is where we're going to float around. I think if there's a conflict, it might go up to 4.6. There'll be an agreement, hopefully by midterms, that brings it down to where we are today. But I think kind of this is the shifting world. And there's a lot of consensus that says that commercial real estate transactions really kind of stop at 4.5, but under 4.5, they really keep trekking along. So I think this is kind of the new world for the end of the year, this 4.2 to 4.5 10-year Treasury.
Yeah. And it's interesting to see, I think a lot of investors the last couple of years are like, well, cap rates are gonna, decrease along with interest rates. And now we're finding that while things are stabilizing, like you said, this might be the new norm that we're operating in, like your underwriting and stuff. This may be kind of the ongoing consensus that you're getting, low fives on your interest rate and, trading your C-class deals at a 6.5 cap or 7 cap as opposed to a 5. And that's just kind of what it is. And so you have to make your business plans work around that. And if it winds up being better, then that's great.
Yeah, well said. But it comes down to somebody like you, though. I mean, this is where if you're an LP, you got to find operators that get their hands dirty and that are going to commit to your deals. I think, that this is the operational component of this is what's going to really, help people, really see the returns that they expect. I mean, Jonathan, I'll sing, I'll sing your praises, even though this is not a paid commercial by any means, but you have an engineering background. And I think that, we've done deals before, and whenever, Class B and Class C, what you've seen even in the Class B space is these 80s assets, and I call that still Class B, but these 1980s assets, you have seen, your bridge lenders and some of the capital move away from this space chasing 90s and above. But if you can find out a way to make this 80s work, I mean, this is where you're getting great basis plays. But in order to do this, these are older assets in some cases. Plumbing is, I'm just hypersensitive on systems and operations of these. So if you can figure out a way to kind of figure out, hey, I've done a real due diligence job, and I've seen that, that the systems are in place to where I'm not going to be spending the CapEx that I expected for interiors to get rents spent on plumbing projects or things that don't increase rents, then you're going to thrive. And I think that's why it's finding operators that actually understand something from an engineering standpoint like you is exceptional. But it's the operator that is important here, because there's still deals to be had. I mean, you've found 2 tremendous deals this year, and so but your deals are a good example of you see 100 opportunities, and you're not trying to get to the point to where you need to kind of have these, you need to keep feeing and get fees and fees and fees and fees and fees in order to feed this enormous engine you have. You're very intentional in saying, no, I'm going to only present opportunities to my investors that I've vetted thoroughly, and that I can look from a market perspective of, no, there's basis here in order to be successful. And that's going to be the key right now is, by all instances, there's a good chance that these 80s products, there's going to be a awesome demand for this in a lot of ways if you know how to weather these storms in the future. But right now, it just kind of comes down to being picky and finding operators that understand the operational component and not just allowing a property management to just kind of take view with no oversight.
I hope you're enjoying the content of this episode. I want to take a quick 15-second break to thank our sponsor for this episode, which is Apogee Capital. Now, Apogee Capital is our private equity firm that we allow investors to participate in large-scale multifamily investment opportunities through. If you're interested in being a passive investor and would like to learn more, you can find information on our website, www.apogee.com. Link is in the show notes. Now, thanks, and enjoy the rest of the episode.
Yeah, absolutely. I think that's really said, and definitely appreciate the compliments. we are a pretty big fan of the 80s stuff. I feel like it's the best bang for the buck. You can go older, right, and get stuff at better cap rates, which in theory should translate to higher cash flow. But in my experience, it never does by the time you pump all the CapEx back into them that you need. Versus the newer stuff, you're really banking on appreciation carrying the returns. And if that's your plan, that's fine. There's nothing wrong with that. I think you just have to be honest about it. But yeah, we've worked on a couple fantastic deals. I think, maybe one that the listeners might be interested in hearing a little bit about was our townhouse apartments deal that we did last fall. Relatively long-term owners that had that property maybe 8 years. So not a situation where someone had it 2 years and they're, about to be foreclosed on, clinging on for life. Like, property's running very well operationally, but just, kind of needed a fresh set of eyes, fresh set of CapEx. And we were able to get it off market. And I remember sending it to you for the first time and just being, Carl, like, I need some feedback on this ASAP. Like, this is an off market deal. We don't have a lot of time. And I think it was like, I sent an email in the evening. By the next morning, it's like, yeah, this is what we're looking at. And it actually looks really strong. And having someone like Carl on your team, that's a great lender that knows what they're doing, is so important. One, from a timing perspective, but two, just accuracy, right? Like, can you really get the terms that we're talking about? So I've kind of rambled on it for a minute or two, but like, from a lending perspective, like what were your thoughts working on that deal? Or, maybe where do you think, you were able to bring the most value on the deal? I have some thoughts of my own, but just curious your perspective on it.
Everybody has a different business plan that does what I do. Some people are like, I want to appeal to the masses. I want to get as many borrowers as I can. I want to try to get 1,000 clients or as many clients as possible. And, they go for mass, and I'm at a point to where I've been pretty blessed from a success standpoint to where I really want to be picky with who I work with. And so by doing that, you can put so much more personal attention on the deals you choose. And, Jonathan, I think it started with, before we even got started, we had a beer together before we worked, and we visited and we spent time. We had a personal relationship, which meant, you were a friend, and I didn't want to let a friend down. And that's kind of where it started with why I got it out so quickly is there's a personal component to where you personally mean a lot to me. And I had extreme respect for what you had already accomplished. So that's where it started. But on that deal particularly, you're always trying, when you get in this, you want to kind of quickly see, okay, where are the advantages here from a lending standpoint? And I looked at kind of the different market comps, and pretty clearly what stood out to me was you were walking into equity. Where you bought that asset was where I thought was significant, maybe not significantly, but it was significantly lower than the market was. So then it was like a strategic of, okay, not only, I think we can get this, but I think that we can really push the lever here because based on the comps I'm seeing, you are walking into substantial equity. So that's when the conversation was, okay, I think we can get here, but I want to let you know what it's going to take to get there. And it was at that point getting prepared for the appraisal so that we can start making a conscious effort to say, don't just do what every appraiser does and just, give us whatever the contract says. Let's take a second. Let's give you the data, appraiser, so that you can, have everything in front of you so that you can immediately start building the narrative of, no, this is worth a lot more than the contract price. And I think that sometimes is a lost art in a lot of transactions. I think especially people that are really busy, they're just, got it in, let's move forward. We get an appraisal, so what the appraisal says versus, no, let's be intentional here. And so I think that transaction was a master class in how do you properly select an asset. So I think that was number one is you just don't see basis plays like that. It was a clean asset. It was in DFW. And so that was great. And then visiting the property, I think that you saw that there wasn't a lot of deferred maintenance, and that was so exciting, and I think we're in a world right now where Fannie and Freddie, there's always this discussion of them potentially going public, and you see more and more, and especially what we saw in the end of the fourth quarter last year of a heightened view on deferred maintenance, especially. And so going out there, personally walking the property with you and seeing the asset, that created a narrative where we could tell the the person doing the property condition report, hey, like, look how clean this is. And, a master class by you, and really a testament to your investors, is you did a tremendous service to me, because you had already gotten a pretty intense engineering report beforehand. And you were able to, so that the narrative of, hey, is there foundation problems? Well, you had data from a third party report that said, no, there's not. Everywhere you're seeing potential cracks, it's settling. And let me show you, it's not as bad right off the bat. It's so much easier, when you're doing these site visits, to have data up front versus the fight on the backside that you're going to inevitably have anyways once you get the report. But I think that you were so well prepared in walking the units, seeing, hey, this is something that might be caught. So this is how we're going to be proactive before, even the site visits happen. So that allowed me to really be able to really push the envelope in a really difficult time. In the fourth quarter, they started doing more requirements on show us every LP investor in the deal, which was, an interesting perspective, and other requirements. And that kind of goes into kind of everything we had to navigate, and it kind of the whole, the lens of, I'm somebody that's very involved in a lot of different areas of politics. And you can kind of see that, when you see reports that, hey, they're potentially going public, well, that should also tell you, well, that means they're going to be under significantly more scrutiny. And so with scrutiny means that they're trying to tighten their books, which means everything new is going to be scrutinized more for this potential public offering. So I think that, you have to be ahead. You have to kind of see, pretty quickly, from my perspective, I have to see, are there any, unique aspects to the deal? And then you, with your master class of already having an engineering report to set the narrative on the PC&A, it all came together. It really did.
Yeah, no, it was definitely a fun deal, and a little nail biting at the end. We were trying to close before year end for tax benefit reasons, and I would say normally it would have been doable, but it was tough because Fannie, the folks there, they're getting ready for Christmas holiday. People start taking off, and you find out people are out of office, and it takes longer to get things done, and probably what we should have been able to close pretty readily mid-December or third week, gets pushed to the fourth week, and we were just working. And long story short, we wound up closing it 45 minutes before wire cutoff on the 31st of December, which it saved, myself 6 figures in paying taxes this year, and investors somewhere on the order of like $3 million or something like that. It was an insane amount of money that we saved by accomplishing that. But I can tell you, the night before, me, Carl, and our team, we're up working with the attorneys till late at night. We had a bit of a rogue title agent where we're trying to do her job, and having someone like Carl that actually knows what's going on in the office was super useful. So we're not trying to guess at what it is she needs to be getting done. And it was a fight, but that's kind of what you got to do in this business to get the big wins. And so it was just, huge win for us getting that done on time and closed with the proceeds that we wanted. And on, like you said, what we think is a pretty fantastic deal. So
yeah, no,
really
great
appreciate
win.
all your help on it. Yeah,
great win. I mean, the last thing I'll say though is, so I was a city councilman for 2 terms in the city of Rowlett. And what was awesome about seeing life from a city council perspective is, you have, city staff, it is pretty similar. Just government as a whole is, you're excited about closing your, $20 million deal. We'll just say, well, for the person at Fannie Mae, this is another file. And so it's like treating their staff with respect, when they, they're busy, so that whenever they have a request, you get back to them quickly. And I think your responsiveness is why we were able to close. I mean, you were living and breathing this for your investors. And that's really how we got this closed.
Yeah. Appreciate it. Well said. Carl, as we kind of get towards the last few minutes of our conversation here, really one of the big reasons I started this podcast was for people who are newer to real estate. They're wanting to learn, just like what I was 7-8 years ago when I started in the business. And so, if you were talking to someone that they're just getting started as an investor, they've heard about the benefits of real estate, they've kind of gotten the bug, so to speak, but they're just trying to get the traction, right? And whether that's as a general partner doing their own deals, or maybe they're just buying some single family properties, or maybe they're wanting to be a limited partner in like one of the deals that we're talking about. What kind of advice would you give someone that's starting in today's environment for being successful as a real estate investor?
So it starts with your team. You have to have people that are going to get their hands dirty with you, and do life with you, because at the end of the day, it's every deal is going to have a problem. So you got to have a team of people willing to get their hand dirty and that are very competent. And then second, I'll just quickly say is your exit. What is your exit? And I think that's very valuable too. I think that I've built one of the best HUD lending platforms in the country. And I say that is right now it's, we're doing so much HUD business because it allows on a refinance a 35-year term, 35-year AM. And there's a lot of benefits that go along with that, that help you survive. And it's thinking about, okay, your 3 to 5 year hold might be a 7 to 10 year hold, right? So be prepared for that accordingly. And in a lot of cases, HUD has allowed people that maybe you're having a hard time, but that 115 debt cover allows you to refinance out to something. So that's important. But then overall, kind of matching, I think one of the biggest things you learn along the way is matching your prepayment penalty with your hold strategy. And thinking that there's a lot of times, like if you really do think it's going to be a 3 to 5 year hold, you need to probably match your debt somewhere close to that versus, just going in and having a prepayment penalty that might hurt the deal. So there's also that aspect that I always kind of caution it as well. But I would think that going back to how we started this conversation in 2008, sometimes you have to really realize that people have gotten hurt in this cycle. It's the bridge debt that's hurt you. It's floating rate and it has a 3-year term. And that's been really, really tough for a lot of operators. So, a lot of times, you can be, it might seem conservative, but long-term debt might be what saves you, because if the environment turns around, then, maybe it's worth, losing the prepayment penalty, but, you paying more in prepayment penalty, but you can sleep at night knowing that you don't have a year before your loan's up, and then, the markets might crumble. So I think those are some pretty intense strategies. Who's your team? Match your prepayment, with your strategy. And then kind of consider on the, maybe do you lock in long-term and look at something like a HUD product that might save you. And the good thing about HUD is it can get to 80% LTV in any market in the country. So, there's a lot of times where you can go into smaller markets and, pick up some really good basis plays, even on 2,000 vintage properties in some of these tertiary markets, and then know that, hey, I have a pretty good exit. But always in your mind, just know that the music can stop at any time, like it did in 2008. Although I don't see that coming anytime soon. But just know that the floating rate debt, it's a means to an end. If you have a property that you really believe is a value add that you can put some money into it, then a bridge can be an excellent option for you to get a good cash out and take an asset and really revitalize it and get some upside. But those that are getting a bridge loan because they just don't have the equity and they're trying to squeeze this in, just make sure you do all your due diligence, because you are taking the risk. So knowing all that, and then, your players, I have a title company, so I see it every day of a lot of the stuff from title at the end. There's just so many requirements. So like, do you have a title group that's like in the war with you? They're responsive. They're going to get back to you. So it's like your team is the most important part of any transaction. I would say if you're an LP, or if you've never bought real estate before, do something with somebody that has a little bit of experience under their belt first, just because you don't know what you don't know. For instance, you don't know, you're going to have to build the sources and uses so that you actually know how much money you're going to have to raise. But if you've never done a deal before, sometimes it's really difficult for you to know all the costs you're going to need, versus knowing somebody that can walk units and say, hey, listen, all right, so we're going to put 5,000 in here. But also we want to make sure that, hey, this is a Class B unit. We don't need to go quartz. We can go marble, or hey, we just need to paint countertops, for instance. So you don't need to over invest in these interiors. But so many people that do this for the first time, they'll go out there and they'll blow out their budgets on different CapEx projects that don't yield any return. So there's so many things that you don't know until you really do it for the first time. And getting with an investor on your first deal that actually can just spend time with them, walk the units, see how they think, read their emails to understand why things didn't go well. What are they implementing? Give them a call. I mean, those are all the important things for investors to do their first time, because this is this is a business now where, there's so many people that, in 2011, really if you bought in 2014, it really didn't take much effort for you to get a 20% right? I mean, it's like everybody,
Yeah.
I think in 2016, it's like the people that made the most money in our business were the people that were making the gold chains that said 10X because everybody needed one. And I'm like, there's no more 10X, whoever was making those necklaces, like they're out of business. Cause like, that's a really, really tough thing to say. Right. So it's like being like, now is the time for you to really understand that competence matters more than anything else. It's not a smiley face. And it's not, hey, you put a stick in the ground, you're going to get an X return. It's being really important of, hey, let's maybe match up with, somebody that really knows what they're doing. And that's so darn important in this environment. So, you have a partner that just did a deal in Fort Worth, and they have an incredible background in property management. And like that's a incredible aspect for them to have, even though their experience was in California, but they still knew, the art of subs and a lot of other things, but they paired with you who knows those subs in this market. So I think more than ever, it's, you probably, if you're getting into this business for the first time, you probably have friends that are living in castles down the street, and you ask them what they did, and they said, oh, we made money in multifamily. Well, you got to understand that there's different waves that come and go, and your expectations have to be realistic to what the expectations in the market, and hopefully you outperform those. But I think that if, I'm an LP investor, I have no intention to do what you do because I know everything that goes into it. And, it's okay being an LP for a while and matching up with somebody in this environment. But I think what's important is somebody like me that's an LP that's in the marketplace knows that if you're promising 25 up crazy IRRs, I know you're probably lying. Like, this isn't like, I'm going to really scrutinize your pro forma. In a lot of cases, I'm going to say, you really don't know what you're doing if you're really thinking you can get this value. I'm seeing this maybe there's some really neat, HUD development opportunities that I'm working on that they're really presenting value. But I think that, if you can get away with, somewhere like a mid-teens return, I think that's a win right now. And that's what I'm investing in. I'm not investing in, 20%, 25%. I'm saying, hey, can I get the tax advantages potentially that comes from, the first couple of years of rehab and depreciation, et cetera. But then it's like, I want to park my money with somebody that I can touch and feel and call and like, hey, what's going on here? Versus in some cases, put it into a stock market where it's like, yeah, data centers sound great, but man, they're falling like a rock one day. They're going up high the next day. It's like, I can't call Elon and say, dude, you just dropped 20% on my SpaceX stocks. Like, we need more satellites. He's not answering my call, but I can call Jonathan Nichols and be like, what happened to unit 106? Like, why has that been vacant for 2 years? And you can say, well, Carl, we're doing this rehab on it and we just got a hold of this asset, but like, we're fine. And I think that's what's so hard is I understand like a lot of people that are entrepreneurs, you want to get in and you just want to go and you think you can do it as good as anybody else. But, if you're risking your friends and family's capital and you really haven't done it before, man, I can't imagine going back to Thanksgiving to somebody that's a close friend and saying, hey, I'm sorry I lost all your money, but just join me on the next one, And so I think it's more important than ever in this environment. Like, I think there's awesome opportunities down the road, but competency is going to be so darn important as we, continue to evolve where we are.
Yeah, really appreciate the vote of confidence, Carl, and appreciate your time today. You've shared a lot of wisdom with the guests. I could talk to you for hours and ask questions because that's how much you have to share. And
Jonathan, I've allocated 4 hours to this podcast, so I'm just warming up. But I'm just kidding.
Yeah, but really appreciate your time and being here to chat with everyone today. I know you're busy with insurance and everything else, so thanks for making the time. And to all the listeners, thanks for tuning in and listening to this podcast. I'm sure you found a ton of value and hope that you'll join us next week. Carl, thanks for jumping on.
Yeah, my pleasure. Thanks, Jonathan.
Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.